Strategy, indicators, and market knowledge are overrated. What actually separates the 10% of profitable traders from the 90% who get wrecked again and again is something so simple most traders dismiss it entirely. And that trait is patience. And if you're like most traders, you're terrible at it. Trading is the only profession where doing more destroys your results. In every other career, activity equals reward. Work more hours, close more deals, complete more tasks, you get paid more. But trading flips this logic upside down and crushes those who don't adapt. Here's a fascinating study that proves this point. Researchers at University of Berkeley analyzed 66,000 trading accounts over 6 years. The most active traders, those who traded the most frequently, averaged annual returns of 11.4%. The least active traders averaged 18.5%. The overtraders weren't just making less money. They were being systematically destroyed by their own activity. The market doesn't compensate you for being busy. It pays you for being right at the right time. The trader taking 50 setups a week often loses money, while the trader taking 5 carefully selected trades builds wealth. This fundamental disconnect between effort and reward breaks most people's brains. Why? Because human psychology craves action. We are hardwired to equate movement with progress, activity with achievement. This isn't a character flaw, it's evolution. Our ancestors who sat still when they should have been hunting or fleeing didn't survive long enough to pass on their genes. We're literally descended from people who couldn't sit still when action was required. But the modern trading environment punishes this ancient wiring. Sitting still feels like surrendering control, but in trading, the need to do something becomes your worst enemy. Your brain, optimized for survival in the African savanna, is catastrophically mismatched for success in global financial markets. Think about it. When was the last time you sat at your charts for 3 hours without clicking buy or sell? When did you last watch a perfect setup form and deliberately wait for better confirmation? Most traders can't handle 20 minutes of inactivity before their fingers start itching for the mouse. That is just expensive. Every unnecessary click chips away at your account, your confidence, and your future in the markets. The neuroscience of impatient trading. Let me tell you what's happening in your brain when you see a potential trade setup. The moment your eyes spot a pattern, a breakout forming, a support level holding, a moving average crossover, your anterior cingulate cortex lights up like a Christmas tree. This is your brain's urgency center, the same region that activates when you're running late for an important meeting. Simultaneously, your nucleus accumbens starts flooding your system with dopamine. This is your reward anticipation center. It's pumping you full of the same chemical that makes gambling, shopping, and social media so addictive. Your brain is literally getting high from the possibility of profit. Here's the kicker. This neurochemical cocktail peaks not when you make money, but when you're about to click the buy button. The anticipation is more intoxicating than the actual reward. This is why traders often feel a strange sense of deflation immediately after entering a trade. The drug hit is over, reality sets in. Professional traders have learned to recognize these neurochemical signals as warnings, not invitations. When they feel that rush of excitement, that urgent need to act, they step back. They've trained themselves to associate the urge to trade with danger, not opportunity. The dopamine trap. Why your brain betrays you. Here's something they don't teach in trading courses. Your brain is working against you every second the markets are open. Dopamine, the neurotransmitter responsible for motivation and pleasure-seeking, operates on what scientists call a prediction error system. When reality exceeds expectation, you get a dopamine hit. When reality falls short, you experience withdrawal. In trading, this creates a vicious cycle. You see a setup, your brain anticipates profit, dopamine spike. You enter the trade, brief satisfaction, then reality sets in, dopamine crash. Whether the trade wins or loses, that neurochemical high is over. Your brain immediately starts scanning for the next potential hit. This is why successful trades can be just as dangerous as losing ones. The dopamine system doesn't care about your P&L. It cares about novelty and anticipation. The trader who just banked a 3 or winner often feels an irresistible urge to find the next setup immediately, even if no quality setup exists. Professional poker player Annie Duke describes this perfectly. The goal isn't to make good outcomes happen. It's to make good decisions regardless of outcomes. In trading terms, this means your dopamine system should activate when you demonstrate discipline, not when you click buy or sell. The most successful traders I know have rewired their reward systems. They get their dopamine hit from saying no to bad trades, not from taking any trades at all. This neurochemical rewiring is perhaps the most important skill you can develop as a trader. The FOMO epidemic. How fear creates poverty. FOMO, fear of missing out, destroys more trading accounts than margin calls, flash crashes, and black swan events combined. But FOMO in trading isn't just emotional weakness. It's a documented psychological phenomenon with measurable effects on decision-making. Dr. Daniel Kahneman, Nobel Prize winner in economics, identified this as part of loss aversion. Humans feel the pain of missing out twice as intensely as the pleasure of gaining something equivalent. In trading terms, the psychological pain of watching a stock rally without you is twice as intense as the satisfaction of catching a similar move. Here's how the FOMO trap works in practice. You identify a perfect setup on Euro to US dollar, but decide to wait for one more confirmation candle. The pair explodes upward without you, gaining 150 pips in 2 hours. Your brain floods with regret, not just the financial loss, but the social loss. You imagine other traders posting screenshots of their profits while you sat on the sidelines like an amateur. The psychological warfare of markets. Trading is psychological warfare, and most retail traders come to the battle unarmed. Institutional players, hedge funds, banks, and algorithmic traders understand that markets are not just about price discovery. They're about emotional manipulation on a massive scale. Consider how market makers position their strategies around retail trader psychology. They know that breakout traders will chase momentum, so they'll false breakout areas to trap these traders before reversing. They understand that support and resistance traders will buy at obvious levels, so they'll penetrate these levels just enough to trigger stops before rebounding. The most effective weapon in this psychological war is patience. When you refuse to react emotionally to price movement, you become invisible to these manipulation strategies. You're not chasing false breakouts because you wait for confirmation. You're not getting stopped out at obvious levels because you place stops strategically, not mechanically. Here's a fascinating study from the world of behavioral finance. Researchers found that traders who check their portfolios frequently, multiple times per day, significantly underperformed those who checked less frequently, monthly or quarterly. The frequent checkers were making emotional adjustments based on short-term noise, while the infrequent checkers stayed focused on long-term trends. This principle applies directly to active trading. The trader who watches every tick becomes emotionally invested in every small move. The trader who checks charts periodically maintains objectivity and focuses on significant developments. The paradox of control. One of the deepest psychological challenges in trading is accepting that you control very little. You cannot control whether your next trade wins or loses. You cannot control when opportunities appear. You cannot control market volatility or institutional order flow. What you can control is your response to these uncontrollable factors. You can control your risk per trade. You can control your entry and exit criteria. You can control how many setups you wait for before acting. This shift from external control to internal control is the foundation of trading psychology. Impatient traders are usually trying to control the uncontrollable. They trade frequently because they believe activity creates control. They chase setups because they want to force opportunities to appear. They revenge trade because they want to control outcomes rather than accept market reality. Patient traders focus exclusively on controllable factors. They control their behavior, not market behavior. They control their decisions, not market decisions. This internal locus of control creates psychological stability that translates into consistent profitability. The ancient Stoic philosophers understood this principle 2,000 years ago. Epictetus wrote, "Some things are within our power, while others are not." The successful trader internalizes this wisdom completely. The compound effect of small decisions. Trading success isn't built on dramatic moments or spectacular wins. It's built on thousands of small decisions that compound over time. Each time you choose to wait instead of forcing a trade, you're making a deposit in your discipline account. Each time you stick to your risk management rules instead of sizing up just this once, you're building the foundation of long-term success. Psychologist Dr. B.J. Fogg, who studies behavior change at Stanford University, discovered that tiny habits create massive transformations over time. In trading, this means focusing on behavioral consistency rather than profit maximization. Instead of trying to double your account in a month, focus on never risking more than 2% per trade. Instead of hunting for home run trades, focus on taking only setups that meet all your criteria. Instead of trading daily, focus on trading only when you have clear edge. These small behavioral changes seem insignificant day to day, but they create exponential results over months and years. The trader who risks 2% consistently will survive market downturns that destroy aggressive traders. The trader who waits for clear setups will compound returns while others donate their accounts to the market. The long game, thinking in decades. Trading is not a sprint. It's an ultramarathon that lasts decades. The goal isn't to make money today, this week, or even this month. The goal is to develop a sustainable edge that compounds wealth over years and decades. This long-term perspective changes how you view individual trades. Missing one setup becomes irrelevant when you know thousands more will appear over your career. Taking a bad trade becomes unacceptable when you realize it erodes the foundation you're building for the future. Warren Buffett has been investing for over 60 years. His average holding period is more than 8 years. He's not trying to beat the market this quarter. He's building wealth that will last generations. While this example is from investing rather than trading, the psychological principle applies at all time frames. The patient day trader thinks about building skills that will work for 20 years. The impatient day trader thinks about profits he can make today. The patient trader studies market structure and institutional order flow. The impatient trader chases hot tips and momentum plays. This time horizon dramatically affects decision-making quality. When you're building for decades, you can afford to miss opportunities while waiting for the perfect ones. When you're trying to get rich quick, every small move feels urgent. The ultimate edge, availability bias. After 15 years of trading, studying every indicator, backtesting countless strategies, and losing more money than I care to admit, I can tell you with absolute certainty. Patience is the ultimate trading edge. Not because it guarantees profits, but because it prevents the mistakes that guarantee losses. Here's why patience is so powerful as an edge. It exploits the availability bias that destroys other traders. Availability bias is the tendency to overweight recent, memorable, or dramatic events when making decisions. In trading, this manifests as chasing the most recent big move, avoiding strategies that recently had losses, or overreacting to dramatic news events. Patient traders are immune to availability bias because they don't make decisions based on recent events. They make decisions based on long-term probabilities and systematic analysis. While others are reacting to yesterday's news, patient traders are positioning for next week's opportunities. Every other edge, technical analysis, fundamental analysis, quantitative modeling, can be learned, programmed, or purchased. Renaissance Technologies, one of the most successful hedge funds in history, employs teams of PhDs with advanced mathematical models. But they also understand the importance of behavioral discipline. Their edge isn't just computational, it's psychological. The beautiful irony is that patience is available to everyone, costs nothing, and yet almost nobody uses it. While others search for complex strategies and expensive tools, the patient trader has already discovered the most powerful weapon in the market: the ability to wait. Breaking the addiction, practical steps. Let's address the elephant in the room. For many traders, the constant activity isn't strategic, it's addictive. The lights, the movement, the immediate feedback, the potential for instant gratification. trading triggers the same neurological pathways as gambling, shopping, and social media. Dr. Anna Lemke, author of Dopamine Nation, explains that modern life provides constant stimulation that hijacks our reward systems. Trading platforms are designed with bright colors, sound effects, and instant feedback specifically to trigger dopamine release. Recognizing this manipulation is the first step to overcoming it. Here are practical techniques to break the overtrading addiction. The circuit breaker rule. After any trade, win or lose, wait at least 30 minutes before considering the next one. Use this time to journal the trade, update your records, or simply step away from screens. This breaks the compulsive cycle that leads to overtrading. The energy account. Treat attention and decision-making capacity like a limited resource. You have approximately 3 to 4 hours of peak cognitive performance per day. Use this energy for your highest probability setups, not for constantly monitoring minor fluctuations. The opportunity journal. Keep a record of every setup you consider but don't take. Review this monthly. You'll discover that most missed opportunities weren't opportunities at all. They were impulses disguised as analysis. The meditation buffer. Before opening your trading platform each day, spend 5 minutes in quiet reflection. This activates your prefrontal cortex, rational decision-making center, and calms your limbic system, emotional reaction center. The physical distance rule. Place your mouse across the room when analyzing charts. This small friction makes impulsive clicking impossible and forces deliberate decision-making. The social psychology of trading patience. One of the most underestimated challenges in developing patience is social pressure. In our connected world, traders are constantly exposed to others' activities through social media, trading rooms, and online communities. This creates a dangerous dynamic where patience appears like inactivity and inactivity appears like failure. Social media platforms amplify this effect. Traders post screenshots of their winning trades, but rarely document their periods of waiting. This creates a distorted perception that successful trading involves constant activity. The reality is that successful traders spend most of their time doing nothing, but this nothing is invisible in social feeds. Professional poker players face similar social dynamics. In a casino, folding hand after hand while others play can feel embarrassing. But professional players understand that folding 80% of hands is not weakness, it's strategy. They're not playing against the cards, they're playing against human psychology. The same principle applies to trading. You're not competing against price movement, you're competing against other traders' emotional decisions. When everyone else is frantically entering and exiting positions, your patience becomes a massive competitive advantage. Your choice, the fork in the road. You're at a crossroads that will determine your entire trading career. Down one path lies the exhausting cycle of overtrading, emotional decision-making, and slow account destruction that claims 90% of retail traders. This path feels active and engaging, but leads to frustration and financial loss. Down the other path lies the uncomfortable discipline of waiting, watching, and acting only when conditions align perfectly. This path feels boring and passive, but leads to consistent profitability and long-term wealth building. The market doesn't care about your timeline, your financial pressure, or your need for excitement. It moves on its own schedule and presents opportunities when it chooses to, not when you need it to. You can fight this reality and lose, or accept it and thrive. The choice between patience and impatience is ultimately the choice between professional trading and gambling, between building wealth and destroying it, between joining the 10% who succeed or the 90% who fail. Most traders make this choice unconsciously, defaulting to their emotional impulses and social conditioning. But you have the opportunity to make this choice deliberately, with full awareness of the consequences. The patient trader understands that success in trading comes not from doing more, but from doing less and doing it better. They know that the market rewards those who wait for their pitch, not those who swing at everything. The impatient trader believes that more activity creates more opportunity. They mistake motion for progress and busyness for productivity. They never give their edge time to compound because they're constantly switching between strategies, time frames, and approaches. Which trader will you choose?